Alright, so let's take a look what is going on with this contrarian spread that I was talking about. Okay, so we have Alcoa today, and we know that Alcoa is the first Dow Jones stock, well, Dow Jones Industrial Average stock that kicks off the earnings season. So a lot of times people will view what Alcoa's earnings, they'll view Alcoa's earnings as a leading indicator of what the season is going to hold in store for us. It's kind of like the old superstition that what happens in January, what happens in January is probably going to happen for the rest of the year. So, like if the market goes up in January, the entire year, the market should go up, right? Something like that. So, anyway, let's take a look at this is the option chain for Alcoa, and this always happens every single time that there's an earnings report that has some notoriety, some hype. And I even showed you on Cisco how it would work for us. Okay, so we have Alcoa. This is the option chain. Let's take a look at, I'm going to change this, and I highly recommend viewing this on YouTube in the HD mode so you can actually see everything. All this has is the implied volatility, the bid, the ask, and on this is the call side, so all the call options will be over here, and this is the put side over here. This always happens when there's an event about to happen. Okay, so we have the closest month option, the July, expires this Friday. The implied volatility is, and we're going for the in the money option. So the current price is $15.91. Closest to that is $16. It's 58.30. Okay? Go to the August 1 month out. The implied volatility is only 35.07. Now here's the thing. Typical characteristics of options and just rules say that the farther out you go, the higher the implied volatility should be. So why on earth is the implied volatility lower for the options that are farther out? Why? And you can also see it on this side for the puts, the 16, 58.83 versus 35.86. These are clearly overpriced. Why? Because of mass crowd psychology. And that's what we like to take advantage of. When the masses are doing something that we know is stupid, we should be more than happy, absolutely more than happy, to help them achieve their stupid action. Okay? That's the game of the option market. So what can we do? We can go over here, look at Alcoa, and say, all right, what has Alcoa done? Oops. What has Alcoa done in past earnings announcements? Let's see. I'll start back in 2010. This one, they had a move about 4%. This earnings announcement, move of about, no, it didn't move at all. This one only moved about 1%, moved about 2%, and I'm just looking at each one of these and then looking at the stock chart below. I'm just looking for a big gap day. Okay, and this one moved about 2%. This one, which was 2 earnings reports ago, moved down about 5%. And the last, and this one, well, actually, let's take a look. Earnings were this afternoon. This one, after earnings, it moved down 9 cents, less than 1%. I'm fine with that. So we're going to take an average and say, okay, so on average, Alcoa moves about 2.5% after earnings. So we want to give ourselves a 2.5% margin of error. And by that I mean, so we're going to do a double calendar spread. We're going to take advantage of these that they're overpriced, and we're going to buy these that are underpriced just to protect ourselves. So we sell the 16 and we sell the 16 put and call for July. And then we're going to go and buy the 16 call and put for August. And it's going to cost us $86 to do everything. Yep, $86. And we look at our risk profile. Actually, let's get this a little more correct. There we go, $62, my bad. We're going to get this a little more correct. We're going to say the day that we get out of the trade is going to be this Friday when the close month option expires. We're going to set our slices. We're going to see what our break-even percentage is. Wow, that's pretty good. We have a 90% chance of profiting from this trade and a 10% chance for losing. For one contract, this is good. For one contract, our maximum gain is, man, would you look at that, $228. That's good. That's very good. Now, our maximum loss is unlimited, but it does flatten out, so let's see. Our maximum loss on either side, and I'm just scrolling this for myself, is about $190. Okay, so we have a good chance of making this trade because we're taking advantage of the overpricing in the closest month options and the underpricing in the further out month options. That's good. That's excellent. So what do? We initiate the trade and we wait for earnings. Actually, you know, I was saying that we have 2.5% margin of error. Okay, right now, let's see, it closed at $15.91, 2.5% either way after earnings, we would still be profitable. So, combined with that, not much price movement, and combined with the historical drop in volatility after earnings, this is a great opportunity for us. So, I did this trade myself earlier today after I found out what the earnings were and that Alcoa barely moved at all. I got really excited. So we're going to see what happens tomorrow, and the way that you finish out these trades, you let the closest month options expire. So I'll let the July ones expire on Friday, and then I will sell the August ones that I bought, just end the trade there, take my gain, and leave. Alright, if you have any questions, post in the comment box.